Okay, so we've got quite a bit to dig into this week.
Yeah, we do.
A whole lot of stuff about tariffs, and it's a complex issue. So we're diving deep this week on this whole tariff thing.
Yeah.
And then it's frankly a little concerning, some of the stuff that's been sent our way. Just to give you a quick rundown, we've got the National Association of Manufacturers reaction. We've got how the stock market's been reacting based on, a CTV news report. We've got NBC News telling us how this might hit our wallets and, our grocery bills and stuff. We've got a report from IB's World about how different industries are going to be affected. There's a North Dakota State University piece about agriculture specifically. And then, of course, the big picture stuff, like from the Corporate Finance Institute, what is a trade war? How do these things work? Motley Fool talking about the stock market plunge, and then JP Morgan, giving us their take on the economics of it all. So it's a lot, but our mission is really to, cut through the noise and figure out what this means for, everyday people.
Right, exactly. And I think one of the most interesting things to look at right off the bat is, how seriously the manufacturing sector is taking it. This isn't just, another day at the office for them.
Right.
The National Association of Manufacturers, NAME, put out a statement, a press release, and it's, there's real concern in there. It's not just a, a kind of pro forma statement. They are really worried about the potential impact on investment, on jobs, on these incredibly complicated supply chains that make modern manufacturing work.
Yeah, absolutely. And it really makes you think about, how much we actually rely on like a global network for so much of our economy.
And it's not just, a company over here making something. It's parts and pieces and materials and expertise coming from all over the place.
Exactly. And to their credit, NEM isn't just sitting there, wringing their hands. They're actually, calling on the administration to find some solutions.
Yeah. They're trying to get ahead of this.
They are. They're talking about, needing to make sure that domestic manufacturers, here in the US don't get squeezed too hard. And specifically, they're saying, look, we need to keep getting those critical components tariff-free.
Yeah, makes sense.
Because, if you think about it, so many products rely on parts and, sub-assemblies that come from all over the world.
Right.
And then, they're also putting forward this idea of, 0 for 0 tariffs, which sounds, pretty reasonable on the surface.
Yeah, basically saying, look, if you don't tax our stuff, we won't tax yours.
Exactly, tit for tat. Let's just try to de-escalate things.
Try to find some common ground.
And that really shows, how delicately they're trying to handle this whole situation.
Yeah, it's a tightrope walk for sure.
Because on the one hand, they want to support American manufacturing, but on the other hand, they understand that we're part of a global system.
Right, and that there can be unintended consequences.
Exactly.
And if we sort of step back and think about it from a basic economics perspective, tariffs are essentially adding a tax to the cost of imported goods.
Right.
So for manufacturers who rely on those imports, that extra cost, it either eats into their profits or they have to raise their prices, which then, could make them less competitive.
Right. And then nobody wins.
Exactly. And that's what NEM is really worried about, is that, this could disrupt the way they do business.
Okay, so let's switch gears for a second and talk about the stock market because, as soon as these tariffs were announced, the financial markets had a pretty strong reaction.
Oh, yeah, they definitely did. It was not a good day on Wall Street.
Not at all.
Yeah.
So the CTV news report that you sent me, it kind of paints a picture of this like shockwave, just rippling through the exchanges.
Yeah, it was a pretty dramatic sell-off.
So give us some specifics. What actually happened?
Well, the Dow futures, they plummeted. They were down something like 1,200 points.
Wow.
The S&P 500 was on track for its worst day since 2022.
Yeah.
And it wasn't just stocks. The U.S. dollar also took a hit. It weakened. It was down to its lowest point in months.
So it wasn't just, a U.S. thing. This was global.
Right. This was a global reaction. Markets all over the world were down sharply.
And that suggests that, this isn't just some little blip on the radar. People are really worried about what this could mean.
They are. There's a lot of uncertainty and fear out there.
Yeah. And some of the analysts quoted in that CTV news report, they were even saying that this could, potentially trigger a recession.
Yeah, that's the big fear, isn't it?
It is. That's a pretty serious consequence.
Yeah, and the stock market often acts as a kind of, predictor of what's to come. So when investors start selling off their stocks like this, it suggests that they're losing confidence in the future of the economy.
Right. They're basically saying, oh, this doesn't look good.
Exactly. And I think that's what we're seeing here.
Okay, so let's get into the weeds a little bit here and talk about the actual tariffs themselves, because, we've been talking about the reaction, but what exactly are we talking about here?
Right. So the NBC News article that you sent, it breaks it down pretty well.
Mm-hmm.
And it's not just, one simple tariff. It's more complicated than that.
Okay.
President Trump announced new tariffs on almost all of our trading partners.
Wow, so it's not like just one country, or?
No, this is pretty widespread.
Okay.
So there's a baseline tariff of 10% that applies to pretty much everyone.
Mm-hmm.
But then on top of that, they're adding what they're calling reciprocal tariffs. And these are aimed at specific countries.
Okay. And those reciprocal tariffs, are they higher than the 10%?
Yeah, they're significantly higher.
Okay, so who are we talking about here?
Well, according to NBC News, China's looking at a potential tariff of 54%.
Wow.
The European Union, 20%, India, 26%, and Japan, 24%.
Okay, so those are some pretty big numbers.
They are. And the administration's reasoning for this is that, they're trying to level the playing field.
Mm-hmm.
They say that these countries already have tariffs on U.S. exports, so we're just, doing the same to them.
Okay, tit for tat again.
Yeah, exactly. And they're also taking into account what they call non-monetary trade barriers, things like currency manipulation.
So that's like, when a country kind of messes with their currency to make their exports cheaper.
Right, exactly.
Yeah.
It's a way to kind of get around, traditional tariffs,
Yeah.
but it can have a similar effect.
Right, because it makes their goods cheaper and our goods more expensive.
Exactly.
Okay, so, and these tariffs, are they like, being phased in gradually, or is this happening like right away?
No, this is happening very quickly, actually.
Oh, wow.
The 10% tariff that's supposed to go into effect this Saturday, April 5th.
So just a couple of days.
Yeah, and then the reciprocal tariffs, those are scheduled to kick in just a few days later on Wednesday, April 9th.
So this is like happening now.
Yeah, it is.
Yeah.
And that's probably part of the reason why the markets are reacting so negatively.
Yeah, businesses don't have a lot of time to adjust.
Right. They're kind of being caught off guard.
Okay, so let's talk about how this is actually going to affect, people like us, everyday people.
Right, because that's ultimately what matters.
That's what matters. So what goods and services are we actually talking about here? What's going to get more expensive?
Well, the NBC News article really gets into the nitty-gritty of that.
Okay.
And it's a pretty wide range of stuff. I mean,
Yeah.
we're talking about things like bedding, furniture, smartphones, computers, even lithium-ion batteries.
So that's like, everything from your bed to your phone.
Exactly. It's pretty much everything.
Wow.
And then there's some more specific things like alcohol, for example.
Oh, really?
Yeah, there's a 25% tariff being considered on all U.S. beer imports. So if you like your Mexican Corona or your Dutch Heineken
Yeah.
or even your Irish Guinness,
Yeah.
you might see those prices go up.
Oh.
And there's talk about potential tariffs on European wines and spirits as well. So, your Friday night happy hour might get a little more expensive.
Oh, man, that's not good.
It's not. And it really just shows how, these tariffs can touch almost every aspect of our lives,
Right.
even our leisure time.
Exactly. And then another big one is automobiles, right?
Yeah, a 25% tariff on foreign-made cars.
Mm.
That's likely to lead to higher prices for new cars or, fewer incentives from the automakers.
Right, because they're going to have to make up that cost somewhere.
Exactly. And it's not just new cars either. There's a 25% tariff on imported car parts as well. Engines, transmissions, electrical components, all that stuff.
And that's going to kick in when?
That one's set for May 3rd.
Oh, okay, so pretty soon.
Yeah. And that means that not only could buying a new car get more expensive, but also fixing your old car could get more expensive too.
Right, because those parts are going to cost more. Wow. Okay, so one thing that really caught my eye in that NBC News article was the section about, those cheap clothes and electronics that people buy online from like Shine and Temu.
Oh yeah, those ultra-fast fashion websites.
Right, exactly. And it sounds like there's a big change coming there with this thing called the de minimis trade loophole.
Yeah, that's a big one for online shoppers.
So what is that loophole and what's changing?
So basically right now, shipments valued under $800, they can enter the U.S. without having to pay any tariffs.
Okay.
And that's a big reason why these online retailers can offer such low prices.
Because they're not paying those extra taxes.
Exactly. But that's all set to change on May 2nd.
Okay, so very soon.
Yeah. From then on, these shipments are going to be subject to duties. Initially, it's going to be 30% of the value, or $25 per item, whichever is higher.
Okay.
And then that's going to go up even further to $50 per item on June 1st.
So basically those super cheap online deals are probably going to disappear.
It's very likely, yeah.
Wow. Okay, so let's talk about food because, everyone's got to eat and NBC News was saying that, fresh fruits and vegetables, those could see some pretty quick price increases.
Yeah, that's a big concern. And it's because the U.S. imports a lot of its produce from Mexico.
Right.
We're talking about like 60% of our fresh fruit and 40% of our fresh vegetables come from Mexico.
So avocados, tomatoes, berries, all that good stuff.
Exactly. And because we're so reliant on Mexico for these products, any tariffs on those goods are going to be felt pretty quickly in the grocery store.
Right, because those are perishable goods.
Yeah.
They got to get here fast.
Exactly.
Okay, so footwear is another area that NBC News highlighted.
Yeah, shoes?
Shoes, exactly. And it sounds like, with these new tariffs on top of the existing ones, imports from China could be hit with tariffs as high as 54%.
Yeah, that's huge.
That is huge. And then there are also tariffs on imports from Vietnam.
Right, so companies like Nike, who manufacture a lot of their shoes in those countries, they're going to see their costs go way up.
Okay, and then finally toys.
Toys. Yeah, a lot of toy makers have moved their manufacturing to Southeast Asia.
Right.
And these new tariffs could mean that those toys on the shelves are going to get more expensive.
Wow, so parents might want to start stocking up now.
Maybe so.
Okay, so this list of, potentially affected consumer goods, it's pretty long.
It's extensive, yeah.
It really touches on a lot of our daily spending.
It does pretty much everything.
So the big question is, who's actually going to end up paying for all of this, and when are we going to start seeing these price increases?
Right, because someone has to foot the bill.
Exactly. So NBC News had some interesting insights on that.
Yeah. So the way it works is the companies that import the goods, they're the ones who initially pay the tariffs to the government.
Okay.
But most economists agree that those companies are going to pass at least some, if not all those costs on to us, the consumers.
Right.
So we're going to end up paying more for all this stuff.
So how soon are we talking about here? When are we going to start seeing these price hikes?
Well, it's hard to say for sure, but we could start seeing some general price increases within a month or two.
Okay.
But as we talked about with the produce from Mexico, some price hikes could happen much quicker, especially for perishable goods.
Right.
And it's worth noting that some retailers might try to absorb some of the tariff costs themselves, at least in the short term.
Okay, so they might eat some of the costs to stay competitive.
Exactly. And some overseas exporters might lower their prices a bit to try and offset the tariffs too.
Okay, so it's not like, a simple one-to-one thing.
No, it's very complex.
But there's also this concern that NBC News brought up that businesses might use the tariffs as an excuse to raise prices on everything.
Oh yeah, that's a real worry.
Even on things that aren't actually affected by the tariffs.
Right, and we've seen this before.
Yeah, like with washing machines back in 2018.
Exactly. They slapped tariffs on washing machines and suddenly the prices of dryers went up too.
Right, even though there weren't any tariffs on dryers.
Exactly. So it's definitely something to watch out for.
Okay, so let's shift gears again and talk about how all of this might affect different sectors of the U.S. economy.
Okay.
So the IBIS World report that you sent, that was really helpful. They kind of broke it down into, winners and losers.
Yeah, the industries that are likely to be hit hardest and those that might fare a little better.
Okay, so who are the losers in this scenario?
Well, manufacturing is definitely up there.
Right.
We're talking about heavy machinery, automobiles, consumer electronics, those kinds of industries.
Okay.
And the reason they're so vulnerable is because they rely so heavily on global supply chains and imported components.
Right. So those tariffs are really going to hit their bottom line.
Exactly. And they have a couple of options. They can either absorb those higher costs, which means their profits go down, or they pass those costs on to consumers, which means their prices go up and people might buy less.
Right. So it's a tough spot to be in.
It is. And the National Association of Manufacturers, they've been very vocal about these risks.
Right. They're worried about the overall competitiveness of the U.S. manufacturing sector.
Exactly. And IBIS World suggests that some companies might try to adapt by, moving their production or sourcing more of their materials domestically.
Okay, so trying to become less reliant on those global supply chains.
Exactly.
And ANAIM has actually done some surveys of their members about this.
Yeah, and the results are pretty concerning.
Oh, really?
Yeah, their Q1 2025 survey showed that a lot of manufacturers are increasingly worried about trade uncertainties and rising costs for raw materials.
Yeah, that makes sense.
And another ANAIM survey found that a large majority of small and medium-sized manufacturers, they expect to have to raise prices because of these trade policies.
Wow.
And a significant chunk of them are also thinking about slowing down their hiring.
So those are some real-world consequences.
Yeah.
Okay, so another sector that IBIS World identified as being really vulnerable is agriculture.
Right. Farmers and food producers, they're definitely on the front lines of this trade war.
And what's the main concern there?
Well, the big fear is retaliatory tariffs.
Right, other countries hitting back.
Exactly. So if our major trading partners decide to impose their own tariffs on U.S. agricultural exports, things like soybeans, dairy products, pork, that could really hurt American farmers.
Because it's going to reduce demand for their products.
Exactly. And soybean farmers, they're particularly vulnerable because they export so much to China.
Okay, so we'll get into more detail on the agricultural implications in a minute, but it's clear that this could have a devastating impact on American farmers.
It could.
IB's World also mentioned the steel and aluminum industries, and those are kind of an interesting case, right?
Yeah, it's a bit of a mixed bag.
Because on the one hand, the domestic producers, they might actually benefit from these tariffs, right?
Right, because it protects them from foreign competition.
Exactly. But on the other hand, there's a downside for other U.S. industries.
Right, the industries that use steel and aluminum as raw materials.
Like construction and automotive.
Exactly. They're going to face higher costs for those essential inputs.
So it's kind of like, one step forward, two steps back.
Yeah, it's a trade-off for sure.
Okay, so let's talk about the potential winners in this scenario. IBIS World said that technology and software might be relatively insulated.
Yeah, they're probably in a better position than most.
And why is that?
Well, a lot of what they produce is digital, software licenses, cloud computing services, those kinds of things.
Right.
And those aren't really subject to traditional tariffs.
Okay, but IBIS World did point out that there's a caveat there.
Right. The hardware side of the tech sector, they could still be affected because they rely on imported components.
So like the companies that make smartphones and computers?
Exactly.
Okay.
But the good news for the tech sector is that they're often very globalized, so they have more flexibility to adjust their supply chains.
Okay, so they might be able to shift production to other countries.
Exactly, and avoid some of those tariffs.
Okay, so another sector that IBIS World thinks might be okay is healthcare and pharmaceuticals.
Yeah, they're probably in a pretty good spot.
And why is that?
Well, a lot of medical supplies and pharmaceuticals, they're either produced domestically or they're considered essential. So they're often exempt from tariffs.
Okay, so they don't want to disrupt the supply of essential medicines.
Exactly.
And then finally, retail and e-commerce.
Yeah, that one's a bit harder to predict.
Because it really depends on how much they rely on imported goods.
Right, exactly.
So retailers that sell a lot of foreign-made products, they're going to be hit harder.
Right.
But bigger retailers with more diverse suppliers, they might be able to weather the storm a bit better.
Yeah, and e-commerce platforms, they're pretty adaptable too.
Okay, so they might be able to find new suppliers more easily.
Exactly.
Okay, so let's dive deeper into the potential impact on agriculture because, we talked about it briefly, but that Farm Doc Daily article from North Dakota State University, that really painted a pretty bleak picture.
Yeah, it's not looking good for American farmers.
So what are the key takeaways there?
Well, the biggest worry is those retaliatory tariffs that we talked about.
Right, other countries hitting back at the U.S.
Exactly, and the article really emphasizes how likely this is. They're saying that these protectionist policies from the U.S. and even the potential move to revoke China's permanent normal trade relations status, those could easily trigger retaliation from other countries, especially big agricultural importers like China.
So they're basically saying, don't be surprised if this escalates into a full-blown trade war.
Right, and they even modeled out a few different scenarios to show how bad it could get.
Okay, so give us some specifics.
Well, in their first scenario, they assume that the U.S. increases tariffs on a bunch of Chinese goods, with rates ranging from 17.5% to 75%.
Okay.
And then they assume that China retaliates by slapping a 20% tariff on U.S. agricultural products.
Ouch.
Yeah, and under that scenario, they project some pretty significant losses across the board.
Okay.
Soybean exports, for example, they could drop by more than 32%.
Wow.
That's like $7.6 billion in lost revenue.
That's huge.
It is corn exports, they could decline by almost 10%, which is another $1.1 billion in losses.
Wow. And what about beef and wheat?
They're also looking at significant reductions under that scenario.
Okay, so that's scenario one. What about scenario two?
Scenario two gets even worse.
Okay.
In this one, they assume that the U.S. imposes a 10% tariff on imports from all countries.
Wow. So not just China.
No, everyone.
Okay.
And that, of course, triggers a wave of global retaliation.
Right. Everyone's hitting back.
Exactly. And in that scenario, the losses for U.S. wheat exports are particularly severe.
How severe are we talking?
They're projecting a decline of over 36%.
Wow.
And then they have a scenario 2B, where they imagine an even more disruptive trade environment.
Okay.
So in this one, the U.S. puts a 60% tariff on China and a 10% tariff on everyone else.
So basically a full-blown trade war.
Pretty much. And under those conditions, the projected losses are just massive. Over 67% for soybeans, nearly 40% for corn, over 25% for beef, and just over 40% for wheat.
Those are some really scary numbers.
They are, and the article translates those percentages into billions of dollars in lost revenue, just to really drive home the point.
Wow. And then they have a third scenario that focuses specifically on the potential consequences of the U.S. revoking China's permanent normal trade relations status.
Right, so this is a more targeted scenario,
Okay.
but it still has some pretty significant implications.
Okay.
So in this one, both the U.S. and China impose reciprocal tariffs on each other's agricultural goods.
Okay.
And even under those conditions, the Farm Doc daily analysis still projects substantial losses for U.S. agricultural exports.
Yeah.
Especially for soybeans and corn.
Okay, so no matter how you slice it, it's not looking good for American farmers.
It's not, and the article also points out that certain regions of the country are going to be hit harder than others.
Right.
The Midwest, in particular, is very vulnerable.
Okay, and which states are we talking about specifically?
Well, for soybean and corn production, Illinois, Iowa, Minnesota, and Indiana are really at risk.
Mm-hmm.
And then for beef production, it's Nebraska, Texas, and Kansas.
Okay.
And for wheat, it's Kansas, North Dakota, Montana, and Washington.
So basically the heartland of America.
Exactly. And the article makes it clear that, agriculture is the backbone of the economy in many of these states.
Right.
So these trade disputes could have a ripple effect throughout those communities.
Right. Lower farm incomes, businesses struggling, potentially even farm closures.
Exactly. It's a very real threat.
Okay, so let's step back for a minute and talk about the bigger picture here.
Yeah.
What is a trade war? How do these things actually work?
Right. So the Corporate Finance Institute has a good overview of that.
Mm-hmm.
They define a trade war as basically an economic conflict where countries start using protectionist policies against each other.
Okay, and what kind of policies are we talking about?
Well, tariffs are one obvious example,
Right.
but it can also include things like import quotas,
Okay.
where you limit the amount of a certain good that can be imported,
Mm-hmm.
or domestic subsidies.
Okay, so that's where you give money to your own industries to make them more competitive?
Exactly. And then there's currency devaluation.
Right, so that's where you manipulate your currency to make your exports cheaper.
Exactly. And then the most extreme measure is an embargo.
Okay, so that's like a complete ban on trade with a specific country.
Right.
Okay, so the key characteristic of a trade war is this back and forth retaliation.
Yeah. One country does something, and then the other country retaliates, and it just escalates from there.
And CFI says that these trade wars often start because of a perceived sense of unfair trading practices.
Right. One country feels like the other country is cheating or taking advantage of them.
Mm-hmm.
And while there might be some short-term benefits to protectionist policies, like protecting certain domestic industries,
Right.
the long-term consequences are generally considered to be negative for the overall economy.
So it's like a short-term gain for a long-term pain.
Exactly.
Right.
And CFI points out that trade wars can lead to slower GDP growth and reduce competitiveness in the global market.
And why is that?
Well, for one thing, those higher costs from tariffs, they often get passed on to consumers in the form of higher prices.
Right.
And when prices go up, people tend to buy less.
Right, so that slows down economic activity.
Exactly. And then there's also the fact that domestic industries that are protected by tariffs, they don't really have an incentive to become more efficient or innovative.
All because they're not facing competition.
Exactly. So it's kind of a lose-lose situation in the long run.
Okay, so let's circle back to the stock market for a minute because, we talked about the initial reaction, but the Motley Fool article that you sent, that really breaks down the market's response in more detail.
Yeah, it was a pretty rough day for investors.
So what were the key takeaways there?
Well, all the major stock market averages were down sharply.
Okay, give us some numbers.
Dow Jones Industrial Average was down around 3.5%.
Mm-hmm.
The S&P 500 fell by 4%.
Okay.
And the NASDAQ Composite, which is heavily weighted towards tech stocks, was down even more, 5.1%.
Wow. So tech stocks got hit particularly hard.
They did, and the Russell 2000, which tracks smaller companies, that was down a whopping 6%.
Wow, so that officially puts it in bear market territory.
It does, yeah. Bear market is defined as a decline of 20% or more from its recent high. And the Motley Fool's analysis suggests that the market was really caught off guard by these tariffs.
Mm-hmm.
They were harsher than many experts had anticipated.
So investors were basically saying, oh, this is worse than we thought.
Exactly. And that fear translated into a lot of selling.
And they pointed out some specific sectors that were really hit hard.
Yeah, companies that rely heavily on imported goods, those took a big hit.
Like Five Below, for example.
Yeah, they were down almost 30%.
Wow.
And then big multinational companies with a lot of international sales and manufacturing, they also suffered.
Like Apple, for example.
Yeah, Apple was down 9%.
Okay. And then tech stocks in general were down.
Yeah, investors are worried about the impact on global supply chains and consumer demand for tech products.
Right, so it's not just about the tariffs themselves, it's about the uncertainty that they create.
Exactly.
Okay, so were there any bright spots in the market?
Well, there were a few areas that held up relatively well.
Okay.
Real estate investment trusts, REITs, they actually performed pretty well.
Oh, interesting. And why was that?
It's probably because treasury yields fell, and that makes REITs more attractive to income-seeking investors.
Okay, so it's kind of a flight to safety.
Yeah, kind of. And then international companies that don't sell much in the U.S., they also did better than the overall market.
Like Mercado Libre, for example.
Exactly.
Okay, so the big takeaway from the Motley Fool article is that there's just a lot of uncertainty right now.
There is, yeah. Nobody knows how long these tariffs are going to last or what the ultimate impact is going to be.
And that uncertainty is what's really spooking the markets.
Exactly.
Okay, so finally, let's talk about the broader economic implications of all of this, because the JP Morgan research brief that you sent, that was really interesting.
Yeah, they took a more macro view of things.
So what were their key takeaways?
Well, they pointed out that the stated goal of these tariffs is to protect American economic interests.
Right.
But the way they've been rolled out has been pretty chaotic.
Okay, so it's created a lot of uncertainty.
It has, and they specifically highlighted the tariffs on the auto industry.
The 25% tariff on cars and car parts?
Right, and they're predicting that this could lead to a significant increase in car prices in the U.S.
How significant are we talking?
They said it could be as much as 11.4%.
Wow, so buying a new car could get a lot more expensive.
It could, and that's just one example.
Right, and because of all of this, JP Morgan has actually revised their economic forecasts for 2025.
Yeah, they've lowered their GDP growth estimate and raised their inflation forecasts.
So basically they're saying that these tariffs are going to slow down the economy and make things more expensive.
Exactly, and they drew a parallel to the steel and aluminum tariffs that were imposed a few years ago.
Right, by a previous administration?
Exactly, and they pointed out that while those tariffs did boost domestic production of steel and aluminum, they also triggered retaliatory tariffs from other countries and made things more expensive for industries that use steel and aluminum.
Right, so it's not a simple equation.
No, it's not. And perhaps most concerning is that JP Morgan has now increased their estimate of the risk of a global recession. Yeah, they're now saying there's a 40% chance of a recession happening, up from 30% at the beginning of the year.
So they're basically saying that these tariffs are making a recession more likely.
Exactly. And they also warned about the possibility of reciprocal tariffs targeting broader foreign taxes like VAT.
Right, so not just tariffs on specific goods, but tariffs on taxes themselves.
Exactly, and they said that that could have a much bigger impact on inflation and economic growth in the U.S.
Wow, so that's a pretty dire warning.
It is. And they also pointed to the experience of the 2018-2019 tariffs.
Right.
They found that those tariffs led to a almost one-to-one increase in import prices.
So basically the cost of the tariffs was passed directly on to consumers.
Exactly. And given that the current tariffs are even bigger and broader, the potential for significant inflation is very real.
Okay, and then beyond the direct impact on prices, JP Morgan also highlighted the negative effect that tariffs can have on business confidence.
Right, all this uncertainty about trade policy, it makes businesses hesitant to invest and hire.
And that could have a ripple effect throughout the economy.
It can. And they estimated that a universal 10% U.S. tariff with retaliation from other countries could reduce U.S. GDP by 1% and global GDP by 0.5% through 2026.
Wow, so that really shows how interconnected the global economy is.
These tariffs aren't just about the U.S., they have the potential to affect everyone.
Right, and it's